Welcome, curious minds, to another deep dive. Today, we're navigating the latest results from CreditAccess Grameen.
That's right. Their first quarter for fiscal year 2026 ending June 30th, 2025.
And this isn't just about, spitting out numbers. We want to get a feel for the strategic pulse of this major microfinance player.
Especially as they're coming out of what's been a pretty challenging credit cycle for the sector.
So our mission today really is to pull out the key insights. We've got their financials, the investor deck, press releases, even the earnings call transcript.
Yeah, we'll connect the dots, look beyond the headlines, and try to give you a clear picture of where they stand.
Looking for those aha moments, as you say.
Exactly. How are they adapting? How are they evolving? What do these numbers really mean for their strategy going forward?
Okay, let's get into it. First glance, Q1 FY26 financials. What are the headline figures we should be looking at?
Well, the top line, total income, it improved sequentially. Came in at INR 1,463.6 crore.
Okay, and maybe just quickly, a crore is?
Right, 10 million rupees. So we're talking roughly 14.6 billion Indian rupees in total income.
Got it. And profits.
Ah, that's where it gets interesting. Profit after tax, or PAT, was INR 60.2 crore. Now that's a big drop year on year, down 84.9%.
Wow, okay. That sounds not great.
On the surface, yeah. But, and this is crucial, you have to look at the sequential picture. Compared to the previous quarter, Q4 FY25, PAT actually improved by 27.5%.
Ah, so a quarter-on-quarter recovery then.
Precisely. And you see that bounce back in profit before tax, PBT too? That rose by a pretty healthy 58.8% sequentially to INR 81.1 crore.
Okay. And what about their core operating profit before setting aside money for potential loan losses, the PPOP?
Pre-provision operating profit, yeah. That stayed quite robust at INR 653.0 crore. So the underlying engine is still generating decent operational profit.
So a mixed bag then. Big year-on-year hit to the bottom line, but definite signs of sequential recovery and solid operational earnings. How about efficiency and margins?
Good question. Net interest income, NII, that grew 7% quarter-on-quarter to INR 937.0 crore.
And the margin itself, NSAY.
Net interest margin held steady at a strong 12.8%. Their interest spread was 10.6%.
That's quite healthy for India.
It is. And what's particularly interesting, maybe a small detail but significant, is their average cost of borrowings dipped slightly, down 8 basis points to 9.7%.
Why is that significant?
Well, it might seem tiny, but that cost had been stuck at 9.8% for the previous 7 quarters. So seeing it nudge down suggests that they're finding perhaps more efficient funding sources, maybe tapping into things like that social loan we'll talk about later.
Right, that directly helps their bottom line eventually.
Exactly.
But bringing it all together, those overall profitability ratios, return on assets, ROA, and return on equity, ROE, what were they looking like?
For Q1 FY26, ROA was 0.9% and ROE was 3.4%.
Quite low.
They are definitely lower than you'd typically want for a company this size, but it directly reflects the impact of their provisioning strategy this quarter.
Meaning they set aside a lot for potential bad loans.
Yes, it tells us they're really prioritizing cleaning up the loan book right now, even if it means taking that hit on profitability in the short term. It could actually signal, a move towards better long-term stability, a healthier balance sheet down the line.
That makes sense, putting the numbers in context. Okay, so that's the financial snapshot. Let's shift to the actual business on the ground. What kind of momentum are we seeing in terms of loans and customers?
Well, disbursements actually set a new benchmark this quarter. They lent out INR 5,458 crore.
That sounds like a lot. How does it compare?
It's up 21.9% compared to the same quarter last year, so strong year-on-year growth. It was, however, down about 15.7% compared to the previous quarter.
Okay, so a bit of a sequential dip in new loans going out the door. What about the total loan book size, assets under management?
Their AUM, or gross loan portfolio, GLP, that remained impressively stable compared to the last quarter. It stood at INR 26,055 crore.
So even with slightly lower disbursements in Q1, the overall book size held steady. That suggests decent performance. Are they still adding new borrowers?
They are. Added 2.16 lakh new borrowers in the quarter.
And a lakh is?
100,000.
Yeah.
So about 216,000 new customers. And here's a key point. A significant chunk, 43%, were new to credit.
Meaning first-time borrowers in the formal system?
Exactly. Their total active borrower base is now 45.62 lakh. Focusing on those new-to-credit customers is quite strategic. It's not just growth. It's about shaping credit discipline right from the start and hopefully building longer-term loyalty.
Right. Get them started on the right foot. Now, we've heard CreditAccess talk a lot about their push into retail finance. How's that side of the business doing?
That's definitely a key growth area for them, a strategic lever. Its share of their total AUM has jumped quite dramatically year on year,
How much?
from just 2.9% in Q1 last year to 6.8% in this quarter, Q1 FY26. That's a growth rate of 134.1% year on year.
Wow. What kind of loans are in that retail finance bucket?
It's mainly unsecured business loans, that's around INR 1,300 crore of the portfolio, and then mortgage loans, which are about INR 250 crore.
And what's the ambition there? How big do they want this to get?
They've set a target. They want retail finance to be somewhere between 12% and 15% of their total portfolio by the end of fiscal year 2028.
So a clear diversification strategy away from just pure microfinance group lending.
Exactly. Tapping into different customer needs, reducing concentration risk.
Speaking of the traditional group lending, their bread and butter for a long time. Any changes happening there in loan structures?
Yes, there's a noticeable trend towards longer tenure loans. The share of 3-year loans in their group lending book has risen quite a bit.
From what to what?
It was 33.3% in Q1 last year, and now it's up to 44.3% in Q1 FY26.
And the thinking behind that? Longer loans.
It's about improving repayment serviceability for the borrowers, making the installments potentially smaller and more manageable over a longer period. It also helps with customer retention.
Right. And maybe creates a pathway?
Potentially, yeah. They see it as maybe creating more opportunities to uh, handhold these customers, build that relationship, and then perhaps guide them towards those individual retail finance products once they have a solid track record.
Interesting link between the two. Okay, let's pivot to asset quality. This is always a critical area in microfinance. How are they managing delinquencies? What do the numbers show?
They're showing consistent improvement here, which is positive. Their PAR plus, that's portfolio at risk, loans overdue by even a day.
Right.
That decreased from 6.9% at the end of March to 5.9% at the end of June.
Right. Movement in the right direction. And collections.
Collection efficiency, including arrears collection, also improved. It was 93.0% in March 2025 and ticked up to 94.1% in June 2025. Crucial indicator, that one.
Definitely. What about the more serious end of delinquencies, NPAs?
So the gross non-performing assets, GNPA, and they primarily measure this at 60 days past due or 60 plus DPD.
Right.
That stood at 4.70%. And net NPAs, NNPA, which is after accounting for provisions, was at 1.78%.
And the 90-day overdue bucket, PR90 plus.
PR90 plus was 3.29%. But what's particularly encouraging, I think, is the trend in new delinquencies, the monthly PR15 plus accretion rate.
That's the rate at which loans first tip into being 15 days overdue.
Exactly. That rate has seen a broad-based decline across all their operating regions. It dropped significantly from 1.34% back in November 2024 down to just 0.46% in June 2025.
That's a big improvement. Fewer new problems cropping up.
Precisely. It suggests the underlying quality of recent lending and collection efforts is improving.
We've talked before about Karnataka being a bit of a trouble spot. Any updates there? Is it stabilizing?
It does seem to be gradually inching towards stabilization. That same monthly PR15 plus accretion rate in Karnataka, it peaked at around 2% back in February 2025.
Okay.
By June 2025, they had controlled it down to 0.58%.
Still higher than the average, but a clear improvement.
Yes, definitely still a focus area for them, but that consistent month-on-month improvement is a very positive sign. And an interesting point they made on the earnings call.
Yeah.
Even within Karnataka, for customers who are in those early delinquency buckets, say less than 60 days overdue, around 40–45% are still making partial payments.
That is interesting. So they haven't just stopped paying entirely.
Right. It suggests they aren't completely disengaging. They're still trying to meet their obligations, which gives the company a better chance to work with them, maybe restructure, and help them get back on track. It's not a write-off situation immediately.
That's a crucial nuance. Okay, so asset quality improving. But you mentioned earlier that their profitability was hit by provisioning. What's their overall strategy for handling these stressed loans and setting aside provisions?
Well, the credit cost itself, the amount they provisioned, actually saw a sequential reduction. It came down to INR 571.9 crore in Q1.
But didn't you say they did big write-offs?
They did. That reduction is despite them undertaking accelerated write-offs of INR 603.2 crore in the quarter. These were part of a larger total write-off figure of INR 692.5 crore.
So they wrote off loans deemed unrecoverable, but that increased the credit cost figure for the quarter.
Yes, those specific write-offs added an extra INR 192.8 crore to the credit cost. But the overall strategy remains conservative. Their expected credit loss, or ECL provisioning, stands at 4.62% of the portfolio.
And how does that compare to requirements?
They hold significant buffers above the requirements. They estimate they have about INR 331 crore more in provisions than needed just to cover the PR 90-plus book.
Okay.
And compared to the standard IRA's prudential norms, those are the RBI's rules. They have about INR 833 crore in excess provisions.
So they're being quite cautious, building a strong cushion against potential future losses.
Very much so. It hurts short-term profit, as we saw, but builds resilience.
Another risk factor often discussed is borrowers over-leveraging people borrowing from too many places. Are they seeing improvements there?
Yes, they highlighted a steady deleveraging trend driven by their internal policies.
How so?
Well, they track how many lenders their borrowers have. The portion of their loan book, the GLP, where borrowers had loans from more than 3 lenders, that stood at 11.1% in June 2025.
And previously?
That's down significantly from 25.3% back in August 2024.
That's a big drop.
It is. And similarly, they track borrowers with high total unsecured debt over 2 lakh rupees, or 200,000. That portion of their portfolio fell from 19.1% in August 2024 to 9.5% in June 2025.
So fewer borrowers juggling multiple loans or excessively high debt levels, that should reduce risk.
Absolutely. It makes the loan book inherently healthier. Interestingly, they also noted that while delinquencies among these highly leveraged borrowers have largely, quote, crystallized, meaning the problems have surfaced, about 80% of even these customers are still making regular payments.
Again, that commitment to repay seems quite strong even among stressed segments.
It does. And beyond just borrower leverage, they manage risk through their operational structure, too. They talked about their 3 lines of defense model.
What does that involve?
It involves dedicated teams, field risk control, quality control, and internal audit, all making frequent visits, doing investigations, ensuring processes are followed correctly on the ground.
Checks and balances.
Right. Plus, the Joint Liability Group, the JLG mechanism itself, acts as a form of security, that peer pressure and support. And their expansion strategy is also risk-focused. They expand into contiguous districts, areas next to where they already operate.
Why is that approach helpful?
It means they're entering areas where they have some familiarity with the local demographics, the economy, the risks. It allows for more consistent replication of their processes compared to jumping into completely new, unfamiliar territory.
Makes sense. Okay, let's talk stability. Capital and liquidity. How are they looking on those fronts?
Pretty strong. Their capital to risk-weighted assets ratio, CRAR, is healthy at 25.5%. Tier 1 capital is 24.6%. That's well above regulatory requirements, giving them a solid buffer.
And cash on hand. Liquidity.
Also robust. They had INR 2025 crore, about 20.25 billion rupees in cash equivalents and investments. That represents about 7.3% of their total assets, so plenty of readily available funds.
And looking forward, can they get the funding they need to keep growing?
Access seems strong. They mentioned having loan sanctions already approved but not yet drawn down, totaling INR 3,093 crore.
Okay.
And another INR 6,490 crore worth of sanctions currently in the pipeline being processed.
So a good runway for funding. Did they raise much in Q1 itself?
They did. Raised INR 2,570 crore in the quarter. And notably, this included drawing down part of their first ever big international loan, a USD 100 million multi-currency syndicated social loan.
Social loan, interesting. Was it well priced?
Apparently, yes.
Yeah.
They mentioned it was competitively priced, even coming in below their average cost of borrowing at the time.
That speaks well of their reputation and ability to tap diverse funding pools.
Absolutely. It highlights their focus on, dynamic liability management. They're actively looking for diverse and cost-effective funding. They have a goal, actually, to get 25% to 30% of their borrowings from foreign sources by fiscal year 2028.
Diversification again, and their credit ratings help here, I assume.
Definitely. They hold strong domestic ratings, AA stable from the major agencies like CRISIL, IGARO, and Hindi ratings.
Yeah.
That certainly helps open doors for funding.
Okay, so financially stable, good funding access. Let's look ahead. What's the management's overall outlook for the rest of this fiscal year, FY26?
Generally encouraging. They pointed to factors like favorable monsoon forecasts, which are crucial for the rural economy where they operate, and strengthening rural sentiment overall. They see this laying the groundwork for a broader sectoral revival in microfinance.
And in terms of their own growth targets?
Their guidance for FY26 projects gross loan portfolio growth between 14.0% and 18.0%.
And how does that break down?
They expect the core microfinance book to grow in the early teens, maybe 13–15%. The overall growth, pushed higher by that expanding retail finance segment, is guided to reach 20–25%.
So retail finance really driving that higher overall growth figure. What opportunities and challenges do they see on the horizon?
Opportunities. They see steady profitability returning, continued access to funding, and that robust retail finance growth continuing. They also mentioned the new MFIN guardrails.
Those are the industry body's
Right, the
guidelines.
Microfinance Institutions Network. Those guidelines promote responsible lending, transparency, borrower protection. They see that framework as ultimately being supportive for well-run players like themselves.
And the challenges?
They acknowledged a potential temporary increase in sort of steady-state delinquencies across the industry as everyone fully aligns with these new MFIN guardrails, which have stricter recognition norms in some cases.
Okay, a transitional effect, possibly.
Possibly. Other challenges mentioned were managing the productivity of their loan officers effectively, and also the temporary sort of operational impacts from that Karnataka ordinance we discussed earlier, which added some complexities there.
How are they planning to navigate these? What about technology and their operating model?
They emphasize their high-touch, high-tech model.
Hmm.
So still maintaining that personal connection through field staff, but equipping them with technology.
Right.
Handheld tabs for digital onboarding, doing the Know Your Customer checks digitally, handling collections. They even use geotagging to verify locations.
And are digital collections catching on?
Yes, they mentioned digital collections now account for 16% of their total collections volume. So a clear shift happening there, driving efficiency, and they're continuing to invest in tech enhancements.
And the high-touch part, the people.
That's also key. They have a specific human capital strategy, rigorous in-house training, rotating employees through different roles to build broader skills, and importantly, linking incentives not just to loan disbursement targets, but to quality customer servicing and sticking to processes.
Focus on quality over just quantity.
Exactly.
Now, one last point. We've heard some noise in the industry, maybe competitors questioning if the traditional joint liability group, the JLG model, is still viable long-term. What's CreditAccess Grameen's take?
Their management seems quite firm in their belief that the JLT model will remain viable, especially as that crucial first step for bringing customers into the formal financial system.
The entry point.
The entry point, exactly. However, they do acknowledge that a customer's time within the JLG model might get shorter.
Meaning?
Meaning, as customers build a credit history faster, demonstrate good repayment behavior, they might graduate more quickly to individual loan products, which of course, CreditAccess Grameen also offers through their retail finance arm.
So the model evolves, but doesn't disappear.
That seems to be their view. They don't see an immediate scalable alternative to the JLG for initially onboarding that specific profile of customer who's new to formal credit. It's more about evolution and providing the next step within their own product suite.
Right, that makes sense. So wrapping it all up, quite a deep dive into CreditAccess Grameen's Q1. We've seen a company clearly navigating some headwinds, particularly the tail end of asset quality issues from the last cycle.
Yeah, but also strategically pivoting. That push into retail finance is significant, and they're leveraging tech while sticking to that core human-centric approach in microfinance.
It really is a fascinating balance, isn't it? That traditional high-touch engagement meeting modern efficiency drives.
Absolutely. And what stands out is the underlying resilience, I think.
Right.
Resilience of the microfinance model, maybe, but also how companies like this are adapting proactively
Focusing on cleaning up the books, deleveraging borrowers.
while simultaneously expanding products and reach. It's quite a dynamic strategy.
It really is. And that actually brings up an interesting thought for you, our listener, to ponder. As this evolution happens, as traditional microfinance customers maybe graduate faster to individual loans, how might that fundamentally change the landscape of financial inclusion in these rural and semi-urban communities? What new opportunities or maybe even new challenges could emerge down the road for both the lenders and the borrowers themselves in this shifting dynamic?
That's a great question to think about, the long-term implications.
Definitely something to mull over. Thank you for joining us for this deep dive today. Until next time, keep learning, keep exploring, and stay well informed.